In August, to be specific, when crude was trading 42, my model showed 26 and it wound up being a low. So ultimately what I think is I will be defeated on that call and we will make new lows. If you look at the rally from January 20th, which is this war of 1812 in the S&P, the rally has been consisted of sectors that you don't want to see leading. We've seen staples, utilities, just not what you want to see. Consumer discretionary, financials, healthcare are underperforming the upside. This whole thing is energy, materials, emerging markets coming back in the crude oil rally, which ultimately I think will be defeated. So I think this presents a sell. Today is options expiration. There's a huge open interest in the S&P at around 1900, and you can see futures gravitating towards that. So I think this is a sell. I am net short right now.
All right. So that's where we are with technical. Hans, you guys are probably more long-term in your thinking, but you think we go down and retest again, or people should just stay the course and be at dollar cost averaging in, or what?
Well, on the market, on the stock market, we've retested the low, right? and we pulled, just to talk the book, what we've actually done. Back in August, we reduced our equity exposure in the U.S. I think we talked about that in one of my prior appearances. We never bought the rally into the end of the year, thinking that we would retest those lows. We've done that. Now, with that cash, we're starting to look at U.S. equities again, and to a certain extent, European equities. With respect to oil, to your good point, I think the short term we could test lower lows, but I think that we are in the process of building a floor underneath the price of oil right now. What is well in train at the moment is the supply cuts, right? That's been happening over the last 12 to 18 months. You're starting to get the talk of some sort of deal with members of OPEC and some of the non-OPEC big oil-producing countries. So that's essentially the things that you would like to see for a bid to be put under the price of oil. And then ultimately, if demand continues to trundle along, we should see higher prices evolve eventually.
Todd, earlier this week, though, it was such a great thing that we were able to rally in equities despite oil being down. And we thought that there was going to be this broad decoupling, that oil would no longer matter to the stock market, and then here we are again.
You just can't fight the fact that the correlation with crude and the S&P, as a trader, it's airtight right now. And to your point, Kayla, if you actually look at the rebound just in the last week, oil has actually underperformed the rally in the S&P. So you have energy shares and materials leading to the upside, as I said. So I do think the correlation is very strong. And then to Hans's point, the one thing we got to keep in mind also is the crude oil market and energy and materials could find a low. We've lost the uptrend in the dollar. The dollar has been sideways since March 2015. I think that goes to the point that the market, and specifically the Fed, is beholden to where the stock market goes. I think the Fed has lost credibility in terms of raising rates. They did it once. Now it's just pretty much, as people get more hawkish, it's overlays right on top of the chart of the S&P 500. So I think the Fed is watching the stock market, and as the stock market begins to push down, I think the Fed stays on hold, the dollar's selling off, and that could put a bit into commodities.
That's a good point. If the Fed starts looking at growth opportunities in China, the stock market, they've already.
What are you kidding? They've